This is Horizons Middle East and Africa. Our top stories this morning. President Trump admits that trade negotiations with China are hard, and the talks are set to continue today for a second day in London. The focus is on easing tensions over technology as well as rare earth shipments. The Trump administration sends around 700 Marines to Los Angeles, escalating its response to the protests and deepening tensions with state officials. California is asking a federal court to halt the deployment of the National Guard and Marines. And Apple shares tumble during the developers conference after the tech giant's software chief confirms they're still struggling with artificial intelligence. Well, a very good morning to you. It's just gone 8 a.m. across the Emirates, 5 a.m. here in London. I'm Lizzie Burden in for Jemana Basechi. Welcome to the programme. Let's check in on these markets because the hopes of progress in those US-China trade talks really are powering equities and futures this morning. You can already see it in the Asia session. The MSCI Asia Pacific Index up 0.6%, but it's looking likely to power Wall Street higher as well. We're comfortably above that 6,000 level for S&P E-minis. Can it stay there? Mike Wilson from Morgan Stanley says you could get 6,500 by the end of the year. You individually had a bit of optimism for Tesla shares yesterday because of the President Donald Trump saying that he wants to make up with Elon Musk, but a bit of downside for Apple off the back of the developers conference, and we'll be getting to that later in the programme. But for now, let's flip over to the cross-asset picture as well. You can see that gold is currently weaker, Brent is stronger. You've got euro-dollar at a 114 handle at the moment, the dollar getting a bit of a recovery this morning, and we've got the 10-year yield steady there at 4.47%. We had that brutal sell-off for treasuries last week, and now we look ahead to that 30-year auction this week and that crucial inflation data tomorrow. So essentially markets caught between the trade optimism and the inflation angst, and there seems to be just enough good news to stay bullish, but nobody getting over their skis until we have a bit of clarity on these trade talks. Let's get over to Asia now. Avril Hong's on standby for us in our Singapore studio. Avril, looks like a bull market over in Hong Kong.
Yeah, Chinese shares in Hong Kong 20% higher than from their April lows. But to your point about the lack of trade talk clarity, it's really interesting how just the idea of these talks continuing seems to be fueling some optimism in this part of the world. We're seeing the gauge of stocks for the region sitting quite high, and this is roughly near the session highs. The biggest boost to the gauge is TSMC, the Taiwanese chip maker, and of course we are expecting its May sales data later today, but it's also sort of being fueled by optimism that, you know, the US could relax some of these chip restrictions. Aside from that, it's also worth noting that among the gainers today, as you highlighted, it's the Chinese stocks, and partially to do with global investor sentiment that's been improving towards Chinese shares overall. If you're looking not just on the Hang Seng China, looking at the MSCI China, it's also about 20% higher from the April low. So this continued recovery from post-Liberation Day declines. Aside from that, also keeping watch on dollar yen that at one point earlier hit the 145.3 level. Some of this to do with the dollar strength that's been creeping back in, but BOJ Governor Ueda has also been speaking in Parliament. He's mostly been repeating his comments, but it also to some reads dovish given how he said that, you know, they're still quite far from reaching their inflation goal. To some that means that pushes the BOJ rate hike even far behind.
All right, Avril Hong out of Singapore with an update on Asia markets. We thank you. Now, I want to dive into these trade talks between the US and China because they're set to continue here in London for a second day. And the aim, of course, is to ease tensions over shipments of technology, but also rare earth elements.
We are doing well with China. China's not easy. We want to open up China, and if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
For more, let's bring in Bloomberg's Charlie Zhu. Charlie, it seems like there's going to be an exchange on export controls for critical minerals in exchange for chips. Is that right? What details do we have about which chips it might be?
Yeah. And Kevin Hassett, the head of the White House's National Economic Council, has told CNBC yesterday that the U.S. is about to ease export controls on China, while China will release rare earth, which is critical to a range of core products, important products, from weapons to computers. So specifically, we're hearing from people familiar with the situation that there'll be easing of controls on exports of jet engines, chip design software, nuclear materials, and other high-tech products to China. But as Kevin Hassett pointed out in his interview with CNBC earlier, that probably the latest list won't include the most advanced AI chips from Nvidia. It's something called H20. It's still not on the table yet.
Okay, and what do we know about China's stance and what comes next today?
In terms of trade talks with China, China has been, saying, the message has been consistent. It's been saying that, there's no winner in the trade war, and dispute can only be resolved through dialogue and negotiations. So for China, trade, remains a very important source of growth. But the stake is high for the country because there's been a lot of front loading of exports in the first few months. Thanks to the 90-day truce reached between the two countries. But yesterday the export data released by China showed the export to the U.S. has been declining, which is the steepest since a couple, in 2 to 3 years' time. So stakes very high. So for China, probably it's very eager to have a trade deal, a sort of agreement with the U.S. So that the economic growth for this year can be maintained.
Okay, Charlie Zhu, we thank you for the latest on those US-China talks, which we will be covering for you out of London all day. So keep across that. Now, the Trump administration has escalated its response to the anti-deportation protests in Los Angeles by mobilizing 700 Marines and another 2,000 National Guard troops. California has asked a federal court to halt what it describes as the illegal deployment of the state's forces. Governor Gavin Newsom also earlier called Trump's moves the acts of a dictator, not a president. Trump, for his part, backed comments suggesting that Newsom should be arrested. And we can get more now from Los Angeles and speak to Bloomberg's national immigration reporter, Alicia Caldwell. Alicia, really good to have you with us on the programme. Governor Newsom's argument seems to be that the deployment of the National Guard made the protests more violent. What are you seeing on the ground?
Well, that's the question right now. So when these protests sparked on Friday in the midst of some raids on workplace sites in downtown Los Angeles, it was rather contained and focused. At the same time, there was a raid at a Home Depot parking lot where day laborers were gathered. Then on Saturday, we saw the same thing. Protests sparked up in the midst of a Border Patrol and ICE operation at a Home Depot in a suburban community southeast of Los Angeles, of downtown. And then, things started to progress rather rapidly. By Saturday afternoon, the president was calling for the National Guard to be deployed. And by calling, I mean he was deploying the National Guard and announced 2,000 troops. And since then, we've had larger protests. Yesterday, the numbers grew significantly, and the violence has increased exponentially as well. Prototypically at night, during the day, the protests, again, originally were sort of organic, somewhat smaller. They grew during the day. But as this event has progressed, the violence has increased and the numbers have increased with each growing day of protests. So what we're seeing now in downtown Los Angeles is those numbers dwindled again this evening after clashes with police. And as you can see, people are being arrested right now. And we're hearing reports that, there's smaller groups of protesters in and around downtown, but law enforcement is actively sort of coordinating arrests in these instances.
And Alicia, what do we know about the legality of the deployment, not just of the National Guard, but especially of the Marines?
Well, it's really a question, I think, on everybody's mind and something that ultimately may be decided by a court. There is a federal law, it's called Posse Comitatus, that generally prohibits law enforcement operations by the U.S. military, by active duty military. National Guard troops are deployed with some degree of routine in natural disasters, in cases of civil unrest between the 2020 George Floyd protests. We saw it here in Los Angeles after the wildfires in January. We've seen National Guard deployed. The difference now is that the state did not deploy those troops. The state did not ask and was not asked about deploying those troops. Instead, they were federalized, something generally the U.S. has not seen since the 1960s when President Lyndon Johnson was in office and deployed the National Guard in response to civil rights protests. And in that instance, those troops were deployed to protect those protesters. So this is really uncharted territory. We've not seen active duty military like this in this protocol, right? So during the 1992 LA riots after the Rodney King verdict, there was significant unrest, riots, looting, buildings burned, military, National Guard and such were brought in, but again, in coordination with state authorities. That's the absent piece here, and that's what's at issue and will be fought out in a court now that California has filed suit.
Absolutely crucial historical context. We thank you for it. Alicia Caldwell, Bloomberg's national immigration reporter. Excellent reporting. And we thank you for staying up late for us as well. Still ahead on the programme, Asian stocks gaining momentum after US officials sounded optimistic about the trade negotiations with China. A deeper dive into how markets are moving next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, Asian shares have edged higher this morning, helped by expectations about those US-China trade talks as officials struck a positive tone after the first day of negotiations. Joining us for more is our MLive strategist, Mark Cranfield. And Mark, I'm looking at an equities picture, a futures picture that's pretty perky this morning. What do we need out of these trade talks to sustain that green on the screen?
Well, basically, it's a bit of a silence is golden kind of reaction that you're seeing from markets after the beginning of the US-China trade talks. Looks like they're going to extend into at least a second day. And although President Trump was saying that China are hard to talk to, he was also saying that he's only hearing good things. And that's what equity investors especially really want to hear. They want to hear that the momentum towards some kind of deal is still in place, even though there might not be anything specific on the table yet. The fact that they're getting closer together, they are still talking, there's been no big falling out. All of those things in the current environment, they're all being taken as positive. That's what investors want to be able to see, is that there's at least a movement forward, that people are still on the same page. Eventually, there's a chance that tariffs could be reduced further or maybe even removed completely. What they don't want to hear is that suddenly, we can't get on, we have to cancel all the talks, we're back to square one, all the big tariffs are going to be slammed back onto everybody. That's the last thing anybody wants to hear. So we're getting further and further away from a worst case scenario. Progress may be slow, but at least from an equity investor's point of view, they think that the headwinds are diminishing, companies can get back to making money, and that eventually a way around it will be found. So that, in a relative sense, is good news. In the background, of course, as well, we're getting relative stability in bond markets and commodities, and people are starting to see that the overall picture is not Goldilocks exactly, but at least it's a relatively calm, benign picture, which generally speaking is good for equity markets.
OK, no news is good news, as my dad would say, as long as things are moving in the right direction on those trade talks. You mentioned it's pretty stable in the Treasury's picture for now, Mark, but of course we've got these all-important auctions at the longer end of the curve this week. What's it going to look like if they go wrong? What does bad look like?
Bad could be really disruptive indeed, and it could spread across asset classes, as you're suggesting there. We've seen before that, particularly when the long end of the Treasury curve, we've got a 30-year auction, that's the one that people are most concerned. There's a 10-year before we even get to that. Expectations are that will go off reasonably smoothly. Yields are relatively high, shouldn't be too much trouble. But we have already seen, particularly with 20-year auctions as well, they're hard to price, and there's not a massive appetite for those in the current environment. So we could easily get a situation where the demand, particularly international demand, is not that high at this week's 30-year auction, and that would be a problem. investors are looking very much towards the fact that foreigners already own a lot of US treasuries, and they gradually seem to be reducing that pile. And you can see the weakness in the US dollar goes in parallel with that. So that's what the situation is, that American investors, of course, will always find reasons to support a treasury market. But if foreigners don't, that's the time when things can get a little bit edgy and erratic, and that's when you could get a sloppy auction. You get one sloppy auction in the long end, that will spill over to the currencies, to commodities, even to the equity market as well. So it's certainly a situation where people will be watching very closely what we get in terms of demand and the difference between the bids and the offers for these bonds here this week. It's not just a question about the auction will go through, the bonds will be sold. At what yield will they be sold? And where will the participation levels be? That's what people will be looking for. Because if this one goes badly, the US has a lot more bonds to sell. We know that this spending bill that President Trump is trying to push through Congress is likely to increase the deficit. If the deficit's going up, that means even more bond issuance down the line. So this is really a story about not just this week, but how it affects the Treasury auctions for months to come. It's a pretty big deal, and we'll be with bated breath when we come to Thursday afternoon.
All right, a crucial test for the unloved long end of the curve. Bloomberg's Mark Cranfield, we thank you for that preview of those Treasury auctions. Now, for a look at some of the other stories we're following this morning, the Freedom Flotilla Coalition says 12 people from an aid boat intercepted on its way to Gaza have arrived at port and are being transferred to Israeli custody. The group says volunteers, including high-profile Swedish activist Greta Thunberg, will be moved to Israeli detention unless they agree to leave the country immediately. The organisers say the civilian boat was carrying food, baby formula and medical supplies, and its interception violates international law. The UN nuclear watchdog says Iran's stockpile of enriched uranium cannot be ignored and urged nations not to turn a blind eye. The warning comes as the IAEA's Board of Governors meets in Vienna this week. The agency reported last month that Iran's inventory of close to weapons-grade uranium is at record levels, growing by 50% in the last 3 months. Elsewhere, Ukraine says that Russia has attacked with drones and missiles early Tuesday morning in Kyiv. This comes after the two sides started a major prisoner exchange. The first groups of prisoners under the age of 25 were transferred. The planned swap of 1,200 people from each side is set to be the largest to date since the invasion of Ukraine. Those are some of your top stories from around the world this morning. Coming up on this programme, Apple has unveiled its most sweeping software redesign yet, but AI-focused investors have been left wanting more. All the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Verdon in London. Now, Apple has unveiled its most sweeping software redesign yet at its Worldwide Developers Conference. But as Bloomberg technology co-anchor Ed Ludlow tells us, the iPhone maker failed to impress investors who were looking for a bit more on the AI front.
The core of Apple WWDC was Liquid Glass, a new operating system interface that basically takes the UI for all of Apple's operating systems and makes the design more uniform. The UI is translucent, it's able to adapt to content and context, but it's very much based in the work that Apple has already done with Vision Pro and the OS for that platform. They're also changing how they name OS. We're going from a version-based labeling system to a year-based one, but for the preceding year. So for example, for iPhone, iOS 26 will be the latest version. Away from that, just remember that WWDC is a developers conference, and probably one of the biggest pieces of news was that Apple will let third-party developers have access to Apple's on-device large language models. In other words, the developer community can look at Apple's technology, its existing work in AI, and use those tools to help develop apps for the Apple ecosystem. And that's the big part of WWDC. It's not just one single day. It's a time where all of the developers that have been so key in growing the ecosystem for Apple come together, and Apple can say, this is the tools that we've got, you can build on top of them. The stock did drop sharply, literally in the opening minutes of the keynote presentation. And a part of that was senior Apple executives basically saying, we have nothing to say about Siri right now. The kind of core of Apple Intelligence and Siri, the delay to some of that functionality, and we won't hear more about that later in the year. Even though expectations around what Apple would or would not say around AI were pretty low going into this, it's a stock that's been under pressure year to date, underperforming many of its Mag 7 peers. But that trading so far in 2025 has been trading on trade risk, tariff headlines, not necessarily on the AI story. The concern coming out today was, well, did we hear enough that we understand the roadmap forward when it comes to Apple and AI? For example, in some of the tweaks and iterations they announced, we saw a deeper integration with OpenAI and ChatGPT than we did Apple's own original work in AI. Even so, the thing about liquid glass and a new operating system interface is that it kind of hints at Apple's next era for design, a software foundation. But read between the lines, take the name liquid glass, and you might learn a little bit about what's coming next for Apple's hardware as well. Ed Ludlow for Bloomberg News in Cupertino, California.
Now for a look at some of our other top stories this morning. Deutsche Bank said that it's rehired Majed Julfar to oversee its business in the United Arab Emirates. In addition to his role as Deutsche's chief country officer for the UAE, Julfar will also head the bank's corporate coverage in the Middle East and Africa. He replaces Kees Hoving, who retired earlier this year. Deutsche Bank recently secured a new branch license in Abu Dhabi's financial centre, and in the past 18 months has made several senior hires in its wealth management and corporate banking franchise. In other banking news, Bloomberg has learned that Barclays is preparing to cut over 200 investment banking jobs. Sources say staff in global markets and research may be impacted, with managing directors the most senior roles affected. The move is meant to give the bank more capacity to invest in priority areas such as European rates, equity derivatives and securitized product trading. Elsewhere, Warner Bros. Discovery shares gave up a 13% opening gain to close 3% lower after announcing a split of its fast-growing streaming business from its legacy media channels. The move unwinds much of the 2022 merger that combined Warner Media and Discovery. The streaming and studios business, which will be led by CEO David Zaslav and will hold a 20% stake in the new global networks business. Those are some of your top stories this morning. A brief check on these markets, and it's pretty risk on this morning. We've got futures pointing higher stateside and in Europe on the optimism around these US-China trade talks as they continue for a second day in London. But coming up on the programme, hear why Mizuho says that the US recession risks are overblown and why they expect the Fed to hold rates in 2025. More on that market strategy next. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. President Trump admits that trade talks with China are hard and the negotiations are set to continue for a second day here in London. The focus is on easing tensions over technology as well as rare earth shipments. Elsewhere, the Trump administration sends around 700 Marines to Los Angeles, escalating its response to the protests and deepening tensions with state officials. California is asking a federal court to halt the deployment of the National Guard and Marines. And Apple shares tumble during the developers conference after the tech giant software chief confirms they're still struggling with artificial intelligence. Those are your headlines. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. here in London. I'm Lizzie Burden in for Jemana Basetchi. Welcome to the programme. If you're just joining us, let's check in on these markets because it's a pretty risk-on picture this morning. Futures pointing higher on both sides of the Atlantic. Equities already higher in the Asia session. We're up 0.6% on the MSCI Asia Pacific Index because we've got these trade talks continuing. And as Mark Cranfield was telling us earlier, no news is good news. As long as the mood music is good, as long as it looks like we're moving in a positive direction back to where we were in Geneva, the market seems to be liking it. Let's flip the board over to the cross-asset picture as well, because we've seen a bit of stability in the Treasury market after that brutal sell-off last week. We've got 10 and 30-year auctions coming up this week, also that crucial inflation data as well. But you're looking at the 10-year Treasury yield currently at a 4.48% level. Euro dollar at 113 now as the dollar strengthens on this optimism around the trade talks. Oil up and gold down. But let's get an update on how Asia markets are faring. Avril Hong's on standby for us in Singapore. Avril, over to you.
Yeah, Lizzie, we're seeing Asia stocks mostly running higher. The region's benchmark roughly at session highs. It's that US-China trade talk optimism you speak of, but also wanted to highlight some of these moves in dollar-yen. We saw a pretty sharp surge earlier. BOJ Governor Kazuo Ueda had been speaking in Parliament. To some, his comments on inflation read dovish, but if you kind of read between the lines, saying that the neutral rate is not 0.5% kind of reads hawkish because it emphasizes this determination to continue the normalization of policy. Against this backdrop, why then did dollar-yen pop towards the 145.3 handle? Our MLive team has been weighing in and they kind of point the finger at options traders ramping up demand for dollar-yen, and this comes ahead of a large strike of 145 that's coming through next week. So maybe that speaks to why we saw that sharp move higher and then moving lower on dollar-yen. Lizzie.
Okay. Avril Hong in Singapore, we thank you for that update on Asia markets. I want to dive into TSMC now. Taiwan semiconductor shares trading around late February highs on these hopes that the US is going to reduce tech curbs on China after the trade talks here in London. Now, the Taiwanese chip maker reports May sales later today, so we can get a preview now with our Bloomberg Intelligence senior analyst, Robert Lee. Rob, good to see you this morning. I wonder, can TSMC surprise the market?
Oh, that's a difficult one. I think we should gain some reassurance that steady as she goes, the demand outlook for their products remains pretty robust. And don't forget, we heard at the shareholders meeting last week, I mean, that was the message that the senior management put forward. If you very briefly consider the three components of revenue, you've got volume, so obviously that's driven by ongoing strong demand for AI and high-end computing. We're also seeing some restocking in smartphones, so that remains pretty robust. You look at ASPs, over the last month or so, there's been some speculation, I would say, that maybe TSMC is raising prices for the 4-nanometer product in the States. So at least the ASP outlook remains pretty solid. Then you've got Forex, which is a bit of a drag given the ongoing weakness of the US dollar. But net, I think that's well factored in by the market. So overall, I think there'll be a pretty robust number. Steady as you go should be the message. Whether it catalyzes the shares or not remains to be seen.
OK, well, I mean, that was my next question. Do you see this as a catalyst for the share price? Is it usually this sales data?
I mean, obviously, if we see a positive surprise, it could be. And going back to some of your earlier comments in the prelude, I mean, it's a pretty risk-on environment at the moment. You've got ongoing talks on trade tariffs between China and America. So if we do see some breakthrough or positive result there, I think, for a relatively high beta tech name like TSMC, that's a pretty positive backdrop to potential further gains. But the outlook, fundamental outlook for the company remains pretty robust through the course of this year.
What are the principal risks that TSMC faces?
Normally, in previous periods, and we haven't seen this for a while, it's quite a cyclical business. So I suppose if we do see a weakening on the economic front into the tail end of the year, depending what happens or what the White House announces between now and then. So who really knows? But I think if we see a weakening on economic sentiment and that translating to some uncertainty in some of their core markets, that's a risk factor. But aside from that, they're an effective monopoly at the moment in terms of high-end chip fabrication. There is literally nowhere else to go in the world. So they've got the market to themselves for AI. And I think at least through the course of this year, the outlook remains pretty robust.
OK. Bloomberg's intelligence senior analyst, Robert Lee. We thank you for joining us this morning with a look ahead to those TSMC sales. Now, Asian shares have been edging higher this morning, helped by expectations around those US-China trade talks as officials struck a pretty positive tone after the first day of negotiations. There are lots of other catalysts on the horizon this week, though, and joining us to discuss them all is Jordan Rochester, head of EMEA FICC strategy over at Mizuho. Always good to see you, Jordan. I don't know even where to start. There is so much on the radar this morning. So I think we'll just go backwards, shall we, to the US jobs report and just the state of the US economy. Are you positioning now for higher inflation from tariffs more than for a potential slowdown now that we've had that data?
I think the position is essentially avoid the idea of Fed cuts this year, which is something that was a non-consensus view of ours earlier in the year. Even when a Liberation Day was happening, we still thought that the Fed would be torn between their dual mandate. And is it the inflation or is it the unemployment component they'll be mostly worried about? They're worried about both, Lizzie. So for us, the concern for the Fed is that this is going to be a stagflationary environment. The tariffs will drive up inflation to around 3.5% by year end if you look at the TIPS market. And the way to think about the Fed is which part of their mandate, unemployment or inflation, is furthest away from their target. And it will be the inflation component that's furthest away. What we've learned from the NFP is once again the sort of dovish consensus of economists on the street for a labour market slowdown was wrong in that number. Now, it wasn't a great number. It wasn't a gangbusters, everything's going really well in the US economy, but it wasn't the slowdown that you expected to see thanks to the federal hiring freeze that happened in May. So underneath the hood of the labour market is there are surveys that suggest that hiring intentions are slowing down, and the unemployment rate typically follows these signals and goes higher. But it hasn't been moving anywhere near as quickly as those surveys imply. So the sort of pessimistic mood amongst economists might be wrong about 2025.
OK, a bold call, Jordan. What am I meant to read into that about your assumptions on the trade talks then? We've got this upcoming July 9th deadline. We've got the US and Chinese officials meeting in London. Where do you think it's all going to shake out and what's it going to mean for the market?
We're going to have deals. Now, it's been after the deal from day one. Donald Trump escalates to de-escalate. And what we've seen this year is the effective tariff rate on all US imports was around 4% going into Liberation Day, a little bit higher after we made some moves on China in February and March. And we shot up to around 28% at the peak of all of this. Now, going into Liberation Day, I remember very clearly reading all the sell-side reports that we could get. And essentially the average of expectations was the effective tariff rate would be around 15%. Now, it shot up to nearly double that. The market took it really badly, naturally. But for us, it was always the case of he wants to strike deals. And he's got one with the UK, yet to be ratified, but that's going to be happening. He's got Japan as his #1 priority, as he called it a few months ago with Scott Bessent leading the charge on that. Then there's China, Vietnam, and India. I think that'll be next in the pipeline. The tariff rate on China is going to be higher than what it was before Liberation Day. But because this is Donald Trump's art of the deal, it will be lower than what we first feared. And the market will take that as a win, even though overall the US will have a higher effective tariff rate, Lizzie. So he gets what he wants, which is higher tariff rates, and he's manipulated the market in a way, in terms of the timing of the sequencing of events, to engineer a rally, which is art of the deal in a nutshell.
OK, I mean, it's very optimistic, Jordan. Not optimism that's necessarily shared by all analysts, even if the market is optimistic about the outcome of these trade talks. I also want to ask you, though, about these Treasury auctions that are coming up this week. 10 and 30-year auctions happening. The 30-year, pretty unloved, right, at the long end of the curve, is a crucial test of appetite for US government debt. How significant would it be if this goes awry?
If it goes awry, well, we've seen a big focus on the long end from politicians in Japan, for example. They started lowering the size of auctions, talking about even the potential for the Bank of Japan to taper their sizes. Could the US political focus change in that respect? That's what I think could happen if you have a few bond auctions go awry. The problem for us is that Scott Bessent said that coupon sizes in the auctions will roughly stay the same as expected. So we were not expecting a significant downgrading of the size of these auctions. And then there's the fiscal stimulus. What happens if the fiscal stimulus goes through in the format that it's already in? These auction sizes are only going to get bigger, Lizzie. But I think the good news for rates markets in that respect is this near-term pushback on the size of the fiscal deficit that might see a smaller one big beautiful bill act go through. So I think we should manage this quite smoothly, more than previous weeks when the volatility was much higher. And then when we get into the second half, Q4 of this year, that's when things will be more difficult. We'll know the size of the issuance. If it's larger than expected on the fiscal side, these auctions are still going to be under pressure.
Just on one particular aspect of that big, beautiful bill, of course, there's this huge debate around Section 899. How are you thinking about it and the question of whether it's going to drive investors away from US assets? Are you just thinking it's never going to pass?
No, anything can happen. It's got support amongst Republicans. It passed through the House, so we have to take into account the scenario this happens. I know there's a lot of lobbying going on in DC right now to change the elements of the text of Section 899. Let's see what the Senate does with that. But for those who haven't heard of what this is, essentially what it means is the tax rate for foreign holders of US assets will be higher if the administration so chooses. Now, that's the if. It's not for all foreign investors. It's for specific countries that are deemed to have unfair tax practices. It would be a list that's updated by the US Treasury every quarter. So it will be a targeted measure. It will matter to those foreign investors in those countries that are targeted. The thing is, the countries that are most likely to be targeted are the ones with digital services taxes and a few others that are in the EU. And they're one of the largest holders of US Treasuries. Now, are US Treasuries included in this measure, or are they exempt? There's all these questions, Lizzie, that I just can't answer right now. But the uncertainty will definitely weigh on the dollar and US assets if it comes to pass.
If only we had more time. Jordan Rochester, head of EMEA FICC strategy over at Mizuho. Always a pleasure, and we thank you for getting up early for us this morning. Well, coming up on the programme, climate policies are putting South African exports in jeopardy due to the nation's high emissions. We're going to discuss the risks for the South African economy next. This is Bloomberg.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres June 13th, only on Bloomberg Television.
Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London, where it's just gone 5:45. Now to Africa. A new study has found that South Africa's key export industries are becoming increasingly vulnerable to climate policies, including cross-border carbon taxes. Net Zero Tracker found that about 422,000 jobs are supported by emissions-intensive industries that export to countries with active or incoming carbon border adjustment mechanisms, CBAMs. For more, let's speak to our very own Anthony Squazine, who's our senior reporter for Africa in Johannesburg. Really good to see you, Anthony. I wonder what CBAMs actually are, if you want to explain for us, and why South Africa is just so exposed to them.
Okay, well, CBAMs are basically a mechanism that is being put in place initially by the European Union, but the UK will follow shortly afterwards. And they are effective taxes on carbon-intensive production processes by exporting countries. So, for instance, if a South African company uses electricity to process its metal, which it exports to Europe, and that electricity is made with coal, then they will be levied a charge on that. And the idea is to make sure that imports into the European Union or the UK face the same taxes that domestic production does, because obviously there are quite stringent climate rules in those jurisdictions. Now, South Africa is very, very exposed to this because it uses coal to make about 80% of its electricity, and coal is an extremely dirty fossil fuel. So it's going to be subject to a lot of taxes, which may make its exports a little bit uncompetitive.
So if CBAMs are here to stay, how will South Africa cope?
Well, it's being pushed to transition its energy generation to more renewables. It has great potential, lots of sun, lots of wind, but these things take a lot of money and a lot of time, and the country is pushing for some sort of leeway, but at the moment it looks like it's going to be struggling to get some sort of exemption. But nevertheless, it has said that this is a protectionist mechanism and has threatened to take it to the World Trade Organization. So it's fairly acrimonious at the moment.
Okay, Bloomberg's Anthony Squazzine out of Johannesburg. We thank you for getting up early for us. Always good to see you.
Thank you.
Right. Meanwhile, the World Bank has approved a $1.5 billion loan to support structural reforms aimed at boosting South Africa's infrastructure. The loan will address South Africa's challenges of low growth and high unemployment by easing constraints in its energy and freight transport sectors. South Africa has vowed to modernise state-owned enterprises and to open key sectors to competition to boost its economy. And the IMF says it would like to see the ZiG, quote, fully becoming a national currency as it considers whether to place Zimbabwe on a staff-monitored programme. The ZiG succeeded the Zimbabwean dollar in April 2024 after multiple crashes. And to boost ZiG usage, measures such as deepening the forex market are needed to ensure full price discovery and eliminate the gap between the official and parallel exchange rates. So those are some of our top stories out of Africa. Coming up on the programme, Nvidia's CEO praises the UK's AI talent, but says the country needs to do more if it wants to unlock its full potential. We'll bring you details of that interview out of London Tech Week next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London, in for Jemana Besechi. Now, Nvidia CEO Jensen Huang has described the UK's artificial intelligence talent as, quote, the envy of the world. Well, in conversation with the UK Prime Minister Keir Starmer at London Tech Week, Huang also said that the country needs more infrastructure to unlock its potential. Let's bring in Bloomberg Daybreak Europe anchor Tom Mackenzie, who's been across all things tech all week, all year, really, and was on the ground for us at London Tech Week. Tom, it was an absolute coup for the Prime Minister to get this sit down with Jensen Huang. I wonder what it yielded, though, in terms of Nvidia actually investing here in the UK.
Well, it yielded some flattery, of course, from the CEO of Nvidia, as you say, describing the UK as being in a kind of Goldilocks scenario when it comes to the talent and the money, the startups, the venture capital community as well, here to support the build-out and development of AI. But as long with the flattery, it also came essentially with a bit of a sales pitch from Jensen Huang, who was talking about that need, the missing piece when it comes to the UK and its AI ambitions being infrastructure. And guess, of course, who plays into that infrastructure? It is Nvidia and their GPUs, their accelerators, their AI accelerators. So that was the sales pitch side coming through from Jensen Huang. But he was absolutely right to underscore the fact that we do have that deep well of expertise and talent when it comes to our researchers, when it comes to our universities, and when it comes to startups and founders and the venture capital that is flowing into the UK, more into the UK than France and Germany combined. In terms of the commitments from the CEO of Nvidia, he's committed to help the UK government train workers in AI skills. And they are also saying they're going to be investing more in their R&D centre just outside of Bristol. But it's not just the UK in focus for the Nvidia CEO. He's also off to France. There's Viva Tech, another big tech event that takes place in the French capital this week. He's also expected to meet leaders and executives from Belgium and Germany as well. So this is a European push by Jensen Huang and some commitments here in the UK before he heads to Paris.
So they're the commitments from Huang. What about the commitments from the Prime Minister? What's he got to put his money where his mouth is? I know he said that there'll be an extra £1 billion to scale up compute power. How significant is that, Tom?
I think it's significant. It's heading in the right direction. Those, of course, within the ecosystem would like to see more than that committed. But, of course, the UK faces its own fiscal constraints, budgetary constraints, as of course, you well know, Lizzie. But an additional $1 billion to build out compute power here in the UK will be welcomed as those around the Prime Minister and in the sector as well look to try and find more in the years ahead to build on that. What really stood out to me was the Prime Minister's commitment to lean into this technology, saying, yes, there will be those who are concerned about job losses as a result of AI, and we should look through that. He says he wants the UK to be a maker of AI, not a taker of AI. And he talked about sectors where he thinks AI is going to make a real and substantive difference: healthcare, education, and defence as well. So this was, again, a Prime Minister really leaning into the opportunities and talking very little about the risks that others say are associated with this technology.
That's a very Starmer catchphrase, a maker, not a taker of AI. Tom, it's the perfect week for you to be launching your new show, Bloomberg Tech Europe. You've had loads of conversations at London Tech Week in the run-up to it. What have been your highlights?
We spoke to the CEO of Supercell. It's a company that makes games for mobile devices. You may have heard of Clash of Clans. You may play it on the tube on your way home, Lizzie Burton, amongst others, of course. They have about 300 million gamers using their games on a monthly basis. 300 million people using their games on a monthly basis. So the Supercell CEO, Ilkka Paananen, talking to me about how AI is going to turbocharge the gaming world, he says, and also what Europe can learn from its strength in terms of the development of games. Europe really does lead when it comes to innovation technology on the gaming front. And Ilkka was telling me, the CEO of Supercell, that we can learn from that in terms of how we develop other parts of the tech ecosystem. He also, interestingly, said Europe should not try to ape Silicon Valley when it comes to the race around AI. We should play to our own inherent strengths and our own inherent culture as well. So play to European culture, play to European strengths. Don't try and mimic Silicon Valley. He said he was frustrated by that continual comparison. I also asked him about geopolitics. Supercell, their majority owner in terms of shareholders is Tencent, the Chinese gaming group, and I asked him if he felt like he had a target on his back given the geopolitical strains between Beijing and Washington. He says he doesn't feel that way. He thinks Tencent are a good, solid and long-term investor, but clearly that may be a consideration for some as well. But the CEO of Supercell really kind of leaning in to his views that Europe is in fact better placed than some may suggest. Interestingly, on jobs as well, saying he doesn't see a significant impact in terms of job impacts and job cuts as a result of the implementation of AI, at least in his space.
All right, Bloomberg's Tom McKenzie, we thank you. And a reminder that Bloomberg Tech Europe does launch later on this week. Do not miss the first show. It's at 6:30 a.m. London time on Friday. Tom McKenzie's up next with Daybreak Europe, but that's it for Horizons Middle East and Africa. This is Bloomberg.